A lot of guys retire with a lot of money and they start investing in things they know nothing about. The gym, they're investing in an ice rink. The next thing you know, it's like, hey, all those cash calls are gone and you're broke.
Is people that make a lot of money and keep money, they keep their egos in check and know how they make money.
The biggest risk you're taking is that the stock market crashes, right?
What I think is one of the more important things is investing and then diversification, right?
I tell my son, is when you ask, like, why am I learning calculus? Like, why am I learning a foreign language? Why am I learning Latin? It's because it trains your brain to solve problems in a way that maybe it wasn't wired before.
What would be minimum to invest with you guys? Sandra, if you could go back and give your younger self financial advice, what would it be? Hello, everyone. Welcome to PlanAssist Podcast. And as you know, this is a podcast to help you make better financial decisions. And the whole podcast is built around three core principles: have a plan, be diversified, seek counsel. And then what we do is we interview successful people who are financially successful or expertise in a particular field that can help you make better financial decisions. And then we always start every podcast off with the same question: is what financial advice would you give your younger self? And so we'll do the same today. I'm excited to have Sander Reed. He's the CEO of Lions Wealth Management in Winter Park on today. Sander has spent 3 decades, so he and I's careers have overlapped a lot, but his career is really focused on managing tactical investment strategies that blend discipline and innovation. Under his leadership, Lions Wealth has gained national recognition for award-winning Catalyst Lions Technical Allocation Fund, which we'll talk a little bit about. He's earned a multiple Lipper Funds awards and gives good Morningstar ratings. He's been featured on Forbes magazine, Wall Street Journal, and currently manages several portfolios with Lions Wealth Management that kind of focus on tactical allocation and then a small cap strategy. Before finding Lions Wealth, he was at Merrill Lynch for a few years and then left and built a national platform that raised more than $1 billion. His education is Harvard, Kellogg at Northwestern, and then our fantastic colleagues locally here at Rollins College. So with that, did I miss anything,
That's
Sander?
pretty accurate. That the Harvard and the Northwestern were more executive programs, just to clarify that. But there's a story behind the Harvard thing. But anyway, yeah, I did a little time in school.
But those executive programs are fun. Just before we kind of get into it, I did the Penn State one or the Wharton one back when I was in executive, and they're pretty intense. I mean, they go, from 6 in the morning to 10 at night for those of you who aren't aware of it, and they're pretty interesting. So you do get a lot of learning from them.
Definitely. It's kind of, when you talk about your younger self, it's like, and it's funny because I just started listening. So I happen to be, my mom's Dutch and I happen to have Dutch citizenship. And I'm like, you know what, instead of surfing the internet, how about, learn Dutch, which I should anyway, because I'm a citizen. But, to the young folk out there, it's like always try to learn something new. The Kellogg program was digital marketing during COVID, and Harvard was the school of negotiation. Always have something where you're learning something different, expanding your horizons a little bit. So that's advice I would give. And, I tell my son, it's like, when you ask, like, why am I learning calculus? Like, why am I learning a foreign language? Why am I learning Latin? It's because it trains your brain to solve problems in a way that maybe it wasn't wired before. So to me, that continuing education just gives you different angles for problem solving, and it's also finding new people and expand your horizons.
That's awesome. So, and then on the Rollins College, so before I ask you to get into the actual podcast, on the Rollins College, I used to go for more than 3 years to that 1 Million Cups that Rollins College hosts. Mm-hmm. And it's basically where someone gets up, it's small entrepreneurs that get up and kind of pitch their ideas and then they get feedback. I found that really interesting. I met a lot of interesting people and found it kind of fascinating to kind of hear some of the stories and businesses out there. But Rollins College hosts that in their business school.
Yeah, that's awesome. It's down the street from us. I had a Harvard Business School and a Rollins MBA working for me. And I'm like, with an undergrad, I kind of need to know what they know. And so I did in those days, they called it the mini MBA. So you learn like every aspect of an MBA, but a week at a time instead of, 2 months at a time. So it's kind of a Cliff Note version of an MBA, which is also very helpful at the time. And yeah, Rollins is down the street from us. So that's
awesome.
Yeah.
Okay, so as all of you know who listen to this podcast regularly, we always start the conversation off with the same question, and I'm going to do it now with Sander. Sander, if you could go back and give your younger self financial advice, what would it be?
Well, I mean, 2 big themes I'd say, like, as an investment guy, the biggest risk, so to myself, right, the biggest risk you're taking is that the stock market crashes, right? So a lot of what we preach to our clients is diversification. Obviously, I invest in the stock market, the futures market. I've got some crypto and all that other stuff. A lot of my life savings is in real estate, and it's not because I don't believe in the stock market, but it's a non-correlator to the stock market. So if you're a real estate investor, your non-correlator is the stock market. So, I think diversification, not just in the stock market itself, but assets in general is a good idea for young folks. And then, me, but what I've seen over the years that is a big mistake when it comes to retirement and is people hit home runs, which is great. It's like you strive to hit home runs, sell a business, exit with a bunch of stock, whatever it may be. What I've seen happen that can destroy retirements pretty easily is when you go out and try to hit another home run and another home run and another home run, maybe in businesses you don't know anything about. In other words, you retire with $5 million and it's like, well, I'm going to take this 5 million and make it 25 million. And 2 years later, it's zero and you're back to work. So, it's okay to take a risk and gamble a smidge, but the older you get, and this is like old school financial planning. I mean, the older you get, the less risk you should take. And I've just seen a lot of guys retire with a lot of money and they start investing in things they know nothing about. The gym, they're investing in an ice rink. And next thing you know, it's like, hey, all those cash calls are gone and you're broke. So, keep a sizable nest egg, go try different things, but keep it in relation to the risk. So that would be my advice to younger people is when you hit that home run, don't squander it.
That is a great way to start this conversation out. So you're going to see. So as I mentioned to you, and we talked last week, when I founded Core Wealth Consultants, I interviewed and talked to and looked at what are successful people doing. And then I inverted it, like Charlie Munger said, invert everything. What are unsuccessful people doing? And I came up with the 3 principles: have a plan, be diversified, seek counsel. So when you talk about have a plan, one of the people that I had on my podcast talked about exactly that. So I can kind of build on that is people that make a lot of money and keep money, they keep their egos in check and know how they make money. And then they don't have to run down a bunch of rabbit holes. That's a great way to make money, but I make my money this way, or you know what I mean? Because I'm the same. You and I, our careers are similar. We see tons of people that make or get a big settlement. And then, 10 years later, they've lost it all. It's crazy.
Right. It's, after taxes and inflation and the AC unit broke and all that other stuff. I mean, it eats up that, the income that you produce off your retirement savings very quickly. We had a lot of UPSers come on board after 1999 when it went public, and that they bought 2 houses, they give their kids a bunch of money in cars, they start going to the casino more often, and 5-6 years in, we're doing a great job for them, but it's like, hey, I can't keep up with your spending, maybe sell one of the houses. So that's you can assume you're going to live to be 80, 90. You can't spend like you make 5 million a year every year for 20 years and think it's going to last. So, and telling people that is also difficult because it's their money. They worked hard to earn it. So it's as an advisor, it's challenging to say, hey, listen, what do you think about downsizing that house? Well, that's where the kids were born. All the personal reasons, or I bought my mom that Bentley. Those are things that you just have to be almost forceful with to get them to save, because once you stop working or playing a sport or whatever it is, that money doesn't flow anymore, but the spending goes up. So that's what makes retirement tricky, I think, for people that have done well in their careers.
And then, so the first kind of principle is have a plan. Now, the problem that I have, interesting enough, and I'll be curious what you think about this, that word is a bad word with a lot of people, right? Both in the business and in client in the thing. And what I have found, and not 100% of the reason, but one of the things that caused planning to get this kind of bad word or kind of not a good view of is back in the 90s and early 2000s, the insurance companies trained tens of thousands of people to go out there and they would say, get a plan, get a plan, get a plan. Well, what the plan did was ended up being more a sales process than a real plan, right? So at the end, they'd sit down with these people, take all their information and say, hey, you need to buy $1 million worth of life insurance. And then the clients are like, well, that didn't help me at all, right? I ended up buying life insurance. And then you fast forward 10 or 15 years when they do need a plan and they kind of push back a little bit. And I'm like, you can't think of it like a sales process. You have to think of it more like you're building a house and this is your CAD system, right? This is all the pieces that you got to make sure that you're covered. And then most importantly, what a plan does is it helps you with the prioritization, right? It puts those financial decisions in the right order. What's kind of your experience and view, or you disagree, which I told it's fine. I don't care if you.
No, Tim, I agree 100%. As a rookie at Merrill Lynch, they pushed it to do plans, which I found a little annoying, and they charge for the plan. So we don't charge for our financial plans, and like you said, it's impossible to do a proper job as a wealth advisor without doing a plan first. I totally believe in that, and it's a rule with the SEC: know your client. Like if we don't know that the client has $1 million somewhere else, even if we don't manage it, or we don't know what their insurance situation is, even if we're not selling insurance, like those are things that, as a proper fiduciary, as we call it, in our business, you have to do it. And I think, look, all of us are a little afraid to like click on a link on the internet or put our phone number in, because next thing you know, you get swamped with things. So I think the confidentiality is really important. Like you're not going to tell your buddy down the street what your client has. So the confidentiality, but what's really cool is, having been in this business so long, that we have people that we did plans for 20 years ago that now are coming true. Like the plan actually works. And 20 years ago, as a
Oh my
young
gosh, it's so awesome.
yeah, it's like, why are we doing this plan? Like, does this even work? And it's like, it not only does it work, it's like almost down to the penny. It's kind of amazing. We obviously want to outperform with the asset classes that we put in these plans, but at the end of the day, no, without a plan, I mean, would you go on safari without a plan? Or what, like you said, when you go to the doctor's office, they don't start giving you pills, right? They say, what's your blood pressure? How old are you? All that other stuff. So it's incredibly important, but again, everyone's afraid of the confidentiality of it. And I didn't even think about, the abusiveness of selling expensive products. That's why you and I are on the fee only side of things, because there's no conflict there, as far as like, we want our clients to do well, and no matter what, we want the cheapest execution and the best performance.
Yeah, exactly.
It is, there's that, we're on the same side of the table.
And I think a lot of people don't connect what I said. I think it's more subconscious than it is conscious. Like some of the insurance companies would put, free lunch, put your business card in here, give you a free lunch. What would they do? A plan. And then all of a sudden, those people have grown up and they realize that those plans were more sales process or sales pitches than they were actual plans. So when they sit down with someone like us that really go at it as a plan, right? So we put a long-term plan together. We go through what are your next 2 or 3 things you need to do. It takes a while for them to kind of settle in and know that it's not our sales process. It's actually their plan.
Yeah, I mean, it's hard for us to give advice, for you to give advice, if we don't know the client, right? Like
Correct.
And we're friends with our clients. We want to get to know them to do what's right for them, right? So it's not only the proper financial methodology, but it's also an opportunity to get to know the person who's trusting you with their life savings. So it's a trust building process for sure, and it makes sense. People are nervous about it. I try to make it a little light. Like for older people, I say it's a Barbara Walters interview, right? So and then once you get going, it goes quickly. And then for younger kids, I say it's a Ryan Seacrest interview, because they don't know who Barbara Walters is. And again, the confidentiality of it is what I stress, because they don't want to think you're selling their data to somebody, or
exactly.
telling buddies about their situation. So anyway, it's an important first step.
So then the second is diversification. And this is the part that I'm looking forward to the conversation with you, because this is really your specialty. And those of you who are listening to this, the financial services business is just packed full of different avenues that all of us go down. I made an early decision to go down more the generalist path, where I wanted to be more like using, again, building as an example, the GC, and then I go hire the specialists. And so I put it all together for people and help them with it, but I don't do it. Though you also do all the pieces as a firm, you also specialize in helping people with what I think is one of the more important things is investing, and then diversification, right? Because as all of us know, concentration creates wealth. Diversification preserves wealth. And one of the things that you specialize in is helping those people who have been concentrated start creating some kind of a diversification strategy through a variety of methods. You want to talk about that? And I want to kind of hit on what's the difference between you and kind of what people would say is market timing and day trading and those kinds of things, right? I mean, because that's not really what you do. It's more helping people diversify in a disciplined, strategic way.
Yeah, I mean, that's a lot, so this might take a second. But
no, I understand exactly.
No, one of the first things. So when I broke away from Merrill Lynch, and Merrill was a great experience in a lot of ways for me, but they've got to pay for a lot of infrastructure. So does Morgan Stanley, J.P. Morgan, God bless them all. I mean, Schwab even at this point, right? But just to compete, man to man on an asset mix, is you and I offer a less expensive, option for our customers, because we eliminate the A shares and all that other loaded expenses, a lot of ETFs in some cases. That being said, we're fighting for 1 or 2 points a year when you're competing against everybody else in the world, and we don't have a brand and everything else. So I randomly, and I'll circle back to you a little bit, Tim. Like I randomly got these large single stock positions in the late 90s and early 2000s, the .com craze, right? When you buy a stock, and go to 100.
Yeah, exactly.
Then, as I mentioned a little earlier, we had a lot of UPS executives that were, worked for the company 30 years, managers, not really financially sophisticated. All of a sudden UPS went public and they're worth $5 million. and we would do the financial plan. And basically they said they'd never sell the stock. So it wasn't like, hey, don't sell that stock. They're like, one of my first EPSers said, I'll break your legs if you sell my shares. So having been a Lake Forest College guy, and you also having been a floor trader, so a lot of our professors and Euro buddies are Chicago guys that
Yeah.
options traded futures. So I've always had a background in options and futures. And rather than just casting away the single stock position dilemma, we embraced it and said, hold on a minute. Okay, what can we do with this position, right? So a big stock position has marginability, so you can borrow against it. A lot of these guys bought a lot of shares, borrowing money to buy more shares. If you look at a Publix or a Darden, a UPS, they could rely on the stock going up 15% a year because the company was private. They felt comfortable borrowing at 5% and buying shares every year. So they ended up with a lot of shares and a lot of debt. So we started with debt consolidation, to a point where even now we're lending on shares at less than, 5%, which is less than a mortgage. And then, okay, the elephant in the room is this is your nest egg. You're not going to sell it. It's one big stock position. Let's hedge it, right? Like if we don't want to sell it, let's not expose ourselves to all this risk. Cashless collar is a very basic trade, where you sell a call, buy a put, and that right away puts the seatbelt on. So if you wake up and you have a British Petroleum oil spill or whatever, you're not in the poorhouse. So hedging is the first priority. And then you can overlay the option strategy or a yield strategy where we borrow at 5 and buy stocks yielding 8. So you have a positive carry, and that creates income. It also creates trading activity. A lot of big indexers will basically slap an S&P on top of a big single stock position, and every year, whatever losses the S&P have, they'll take those losses and sell the shares. So we do that, but in a much more sophisticated way that produces income, hopefully, in most market environments. We hedge the positions that we trade. Leverage can be dangerous, so we can lever up or lever down depending on risk. But that creates, whereas you have a stock that most advisors won't touch, brokerages, bother the broker every year to go ahead and ask Mrs. Jones to diversify. You can stay in that stock position and create income and let your wealth grow. The handful of billionaires of whom I've managed money for in my career, all were single stock position people. Like you said, Grandpa didn't start the company with diversified portfolio mutual funds.
That's right.
Grandpa started the company, it went public, he wanted control. And then you also get into a situation where, let's say you've got 5 or 10 million in one stock, and you're 70, right? And you've got kids and grandkids, with the step up basis in taxes, in some cases, you're better off not selling the stock because you pay the capital gain and you never get that money back from the IRS ever again. Whereas, if you hold the stock, hedge it, use it for income, you can get to a point where the kids get the step up in basis and then they can sell it basically tax free. So that's another thing that comes along with managing wealthy people's money is it's almost like we do, and we're not CPAs, but we do a lot of tax advising that goes hand in hand with wealth management because no one wants Democrat or Republican, no one likes to pay taxes. So a lot of the single stock position area that we're in, also is trying to gain a tax advantage. Not giving away the ranch because someone told you to diversify 5 years ago. So, and there's a lot more to it. I guess the analogy I use is, the old analogy that Indian uses every piece of the buffalo. We're the firm that can basically get in there and use every piece of that single stock position to the benefit of the customer. And, sometimes in the .com craze, we had guys that bought stock at 10, it was at 100. And, they were 12, let's say 10 months in, and they're like, I don't want to sell the stock because of capital gains, 40% as opposed to 20. So we said, well, why don't you hedge it? Well, the guys so that same stock, it went up a little bit more, went back down to 10. The guys that we hedged it for had all their money, like they sold it at 90, let's say. So it's locking in gains in some cases because you get to keep that profit from the hedge. So there, if you think of an engineer that started with NVIDIA 5 years ago, they're probably worth $2 to $4 million. Or someone that on a whim bought Apple, right? And now all of a sudden they've got 2 million Apple. What do you do with that position? Go to Costco. Those guys that work at Costco for 25 years, they've got a ton of shares. So those are the kind of clients that we can help, and it is very specialized. So to answer the prop trading thing, the analogy I give is in the old days, you and I had travel agents, Tim. Like if you want to fly to Chicago, you got to have a travel agent, you get a paper ticket, with your name on it. Now we can buy a ticket online in 5 minutes. I hate to say for free, but for the cost of the ticket, basically. But it's a little bit different if you're going to go on safari, in Africa, or and look for wild buffalo or whatever. You need a guide, you need a travel agent, all that stuff. The bigger the assets are, the bigger the situation is, the more you need an advisor. And for me, it's like our clients can buy S&P 500 for free. They can buy a canned portfolio for free. The programs that we run require skill. And I think it's almost a dying trade, stock selection, options, overlays. The tactical aspect of our investing is this, and you'll appreciate this. I don't know, I can't remember if you were in the business in 2008, but it was devastating.
Yeah, I was in the mid 80s. My first
Oh, right. Well, yeah,
experience was
right.
87.
That's
So
right. That's right. I apologize. So, we were practically crying. Our clients are crying. So it's like, well, why do you have a tactical program? Why is your algorithmic stuff? Does it have an exit? Because we don't want our customers to ever go through that again. And we can be wrong. Like we can have a tactical shift that's incorrect. We can get out of a stock that goes up. There's no such thing as I say as a perfect signal. But at the end of the day, if the market rolls over in the majority of our programs, whether it's the yield program, the algo, or tactical, which has won all these awards, we are exiting the market. Like we will not go down with the ship. And again, exits can't be perfect all the time, and we might be early or late. But we don't want to give, we want to give our clients a way out of the next market decline. And that's just because I experienced 98, 01, or 2000 and 08. Like I want to be able to make money for our clients when the market's going up or sideways, which it usually is. I don't want them set back 6 or 7 years with a 2008 type of correction. So we have those exits in place for the benefit of our customers and selfishly for us. We don't want our AUM to go down 40% overnight, right?
Yeah, that's right.
The program that we raised the $1 billion for was tactical, and I hired those guys after. So they were Sub-Advisor Alliance. They were up 2% 2008 because they tactically shifted out of the market, and they were up a lot in 2009. So we had other advisors allocating to us. And if you think of an advisor where their portfolios went down 30, 40%, they had nothing to say to their clients, right? And then we bring a product that says, if there is another crash, you can possibly get out. And of course, the S&P has done so well since then. It's a tougher sell these days. But so then we sold that $1 billion back to those guys and then launched our own tactical, which has been number one several times over the last decade, and many accolades, awards, all that other stuff. But market's very high right now. We've got that Goldilocks vibe. I'm allocating more and more to the products we have that have a defensive shift, just because I don't want to get caught in some sort of downdraft. I mean, just looking at the market, I think it was 21, 22. There was a significant, it was a 20% downdraft. We may not get out of all of that, but those are some, if you look at how much wealth is now in the market, it's a little bit scary at these current levels. So,
yeah.
But I can't predict the future either. So let it run if it runs, but if it starts rolling over, we're going to cash. And I think it's, especially for people in retirement age, that's an important vehicle to have.
Yep, I agree. I mean, and to the single stock, I mean, just recently, I have a couple friends that have a bunch of United Healthcare. I mean, that went down 50%.
Yep.
I mean, so if you had $2 million, in United Healthcare, I mean, all of a sudden that turns into $1 million. That kind of changes. And over the years, I've had tons of these conversations. I can remember, like it was yesterday, having a conversation with someone who was at Merrill,
Right.
And all those advisors that were at Merrill or worked at Merrill, they had a bunch of Merrill stock, and they kind of saw it as I even got into a debate with someone that had a bunch. I said, Merrill is not a treasury. I mean, that's still a company,
Right.
Now, no one believed, including me, that it would ever go out of business. But for all practical purposes, it did.
Right.
People don't realize that. I mean, if you own the stock, you lost almost all your money.
Yeah, I mean that's actually a real life story. So again, getting back to single stock position, we were on the Schwab platform, the TD platform in the early 2000s, and we had the largest single stock position holder of Citigroup in the United States, $2 billion. We didn't have all of the assets. We had a chunk of
Right.
it. And the stock was at 60. So Citigroup in 2006, let's say, was a Dow 30 component, one of the biggest banks.
And I just want to make sure, so people listening, Citigroup is who owns Smith Barney, right? So if you had your account at Smith Barney, that was like one of the big banks. It would be Chase today. So go on.
And to your point, it's just like Merrill Lynch. Like, well, these guys, too big to fail, that whole thing. So anyway, the stock's at 60, and remember, you can borrow against your big stock position. So your Jet, your Aspen Pad, all that, these guys borrowed against their stock, yielding 6% at the time. So it's massive dividend. Well, now, so then the bank, crisis starts, and you have the stock go to 40, and I know exactly where the debt look. So we had the largest Citigroup shareholder in the country, plus all of his buddies, right? So I'm looking at the positions and the amount of money they borrowed, and Wachovia was the bank that they started at, most of them, which ended up being Wells. But anyway, so I'm like, look, guys, stock's coming down. It was at 35. Now I'm like, at 20, you're going to have margin calls, right? And it's a simple trade. I can sell a call, buy a put, and collar it. So if it goes to zero, you don't have to give up your mansions and your jets. And at the end of the day, so the stock get to 20, they said, we know the CEO, and he said it's going back to 35, so we don't want to write a cover call and buy puts. And I said, look, from here on out, you're going to get liquidated. And within months, it went to 75 pennies. So that portion of the Citigroup positions got wiped out, which was horrible for our firm too. But the point being, hedging isn't free. Buying car insurance, if you don't crash your car, you don't get your money back. So the bottom line is, but having defense at that point would have been, and some guys did and came out, smelling like roses, but guys that opted not to hedge, it was an absolute disaster. So
no, I mean,
do that.
and again, back to the audience, so you guys listening, Citigroup was the big bank, but it owned a bunch of different companies. So all those advisors, branch managers, regional managers at Smith Barney, money managers equally got wiped out. I mean,
Right.
just so, I mean, it really does happen. And so that's why when I went back and looked at the three kind of core principles that I built Core Wealth on was have a plan. And again, I just want to kind of summarize. That doesn't mean you want to have a plan that goes out 15 or 20 years, just like you would have CAD system to build the system. But really, the plan is not what makes you rich. It's the actionable short-term items that make you rich. It's the sit down with an advisor and here's the three things we're going to do. Let's increase your 401k contributions. Let's update your will, and let's pay off this credit card, right? I mean, whatever it is, and then kind of redo that in 6 months and redo that. So remember that plan has a timeline attached to it. The second is diversification. And again, what we just got done talking about is almost anyone that builds a net worth of a couple $1 million will find themselves concentrated at some point. I personally, I worked at Schwab in the early 90s.
That's
I
right.
still own Schwab stock that's
Right.
under $1, right? I mean, I
Right.
literally own Schwab stock. So, but in the late 90s, I was like, you know what? I'd already gone through 87. I'd been a commodity trader. So I'm not one of those that kind of gets stuck in this. It can't happen. I'm like, it can happen. And you need to think through that when you get there, which means some kind of a diversification strategy. And then that takes me to the last kind of conversation is seeking counsel. And here's just for you, Sandra, to kind of set up what I think about seeking counsel. I get a lot of feedback from people, especially in the industry. So my buddy friends and stuff, they're like, you shouldn't use seeking counsel, you should whatever. I'm like, I don't care what you call it. Seeking counsel is basically getting input. And people who are successful, they get lots and lots of input. People who aren't successful just go down and go get themselves in a bubble and think that they're absolutely right. And so you can call it curiosity, you can call it, I want input. But most people that I've worked with, and I'll be curious if you found this to be true, people who are really successful financially, what they're looking for when I use the word seeking counsel is they want to get good sense of what's best case, what's worst case, and then what's likely, right? I mean, that's really what they're after. I mean, so then if you sit down with someone who's really kind of unbiased and not emotionally attached to investment, they'll say, okay, well, I'll buy this stock, it'll go up tenfold. Great. Okay. That's fantastic. But in reality, a stock that can go up tenfold means it can go to zero. Right.
Mhm.
And then
Right.
likely it goes up too. Right. But you could do the same analysis on real estate that'll have much less kind of swings. Right. It'll go up 20%, down 10%, likely 5%. Right. But whatever financial decision people are making, that's what they're getting at when they seek counsel. And that's what I really try to stress with my clients. It's like, don't think of me as the genie you call and say, here, what's the answer? I'm going to
Right.
give you a couple options, and then don't be shy and asking for feedback from a variety of sources.
Right. And I mean, you and I are smart guys, but we don't always know the answer. We got to do our own research every once in a while. But yeah, I mean, another analogy I use is if you got a little rowboat, you can handle that yourself. But if you've got a yacht, you pretty much have a captain, right? So wealthy people,
That's a good one.
have the captain to run their portfolios. And I tell our clients, you're going to make money in your business, whatever what the market should be is a store of wealth. Now, there are programs that do incredibly well. Diversification, it can be defined in a lot of different ways. What scares me a little again is people that say that they're safe investors because they're index investors. An index can be down 80%, right? If you remember the Nasdaq in 99. So I think a lot of indexers have been lulled to sleep. And that's why even if you don't have a tactical strategy or something that exits, and I hate to even say this, but you've got your gold, you've got your crypto, you've got real estate. There's areas that might go up when the market goes down. That doesn't mean you have to be exiting the market or trading tactically, but to have a S&P 500 portfolio or Mag 7 and say I'm a safe investor is foolish.
It's
So
just silly.
and like
Exactly.
I say, if that's your situation, God bless you for having done so well lately, but you should seek counsel because if things change, which they always do, and you're not prepared, as I say, they don't call me and say, hey, Saundra, the market's about to crash next week. We don't know till it starts. We don't know why it's crashing, and we don't know how far it's going to go. So if you don't have the other analogy, if you got to have your seatbelt on before the car accident. So because we don't know when that's going to happen. But again, like you said, seek counsel. It's what we do for a living. Like some things we can do ourselves, like buy a plane ticket to Hartford. But I don't want to do ear surgery on myself, so I go to an ear surgery doctor. I mean, that's kind of the
Yeah,
difference
no,
there.
that's right. That's a good
Yeah.
example. So to kind of finish I guess you can kind of add something to this, but the way I want to kind of finish it with is on two questions is what are kind of one or two investment principles that you have found just served you from the time you got in the business? Like what are some kind of core investment philosophies that you share with your son that you just, if people know you, they're like, oh my gosh, here he goes again.
Well, it's a great question. I haven't thought about it in a while, but I'd say my first answer is what is it, The Millionaire Next Door?
Huh?
You know, uh, people generally have a lot of money because they're frugal. I mean, they
Right.
make money, but they're also not flashy. The wealthiest people I know that I've gone to school with and whatnot, I mean, you don't even know they're wealthy, right? So flashing wealth is not only like asking for trouble, lawsuits, things like that, but it's also, it doesn't help you. You know, buying an expensive car might make you feel good, but it's a horrible investment unless it's for taxes, right? Unless it's the big 6,000 pound Land Rover.
Yep.
So that's one thing. And then I'm trying to think what the second part was. What was that, Tim? The question you had? Uh,
Just that's good. I mean, kind of investment philosophy, just kind of,
oh yeah.
or kind of, your
Well,
philosophy in general principles.
yeah, so I think we share this. It's like, I actually bid on this a library. I'm not say which one, but it's against a couple big wirehouses, and these are their big asset allocation teams, and they literally proposed a 60/40 index portfolio. I mean, I can't believe it. So to me, if you're going to spend the money to have an advisor like you and me, Tim, you need to have a guy that has skill, that has experience. So to me, it's like if your value add your customers is a pie chart of index funds, I just I think you should be in a different business. But so what we try to do is we'll definitely buy indexes. It's not that we don't. We'll buy ETFs or whatever it might be to cover areas like Europe or Asia that I don't have the time or expertise. But as far as managing money goes, like we like to manage money ourselves on behalf of our clients. And I think if you're an investment professional, that's what you should be able to do. And you may not choose to do it, but if these guys that outsource pie charts, it blows me away. They're just good salespeople. They're not really investment managers.
That's one thing that our business, and I talked about it early in this on this call. Our business is full of really, really good salespeople,
Right.
and that's fortunate and unfortunate, right? I mean, the salespeople are the ones that I think gave Plan a bad name, right? I mean, they're good salespeople, but then behind it, there's nothing, right? It's just
Right.
kind of void, and people that have interacted with salespeople know that. So,
Right. And the problem with that too is again, we've had these amazing index years. I mean, I think probably that's 5 years, maybe ever for the S&P, but is your guy going to know what to do when the market's down 30%? Like, where is he going to put money? Does he even have a plan if things don't go the way the market's been going? So, that's really the risk right now, I think, is a lot of guys have no idea what to do in turbulent markets.
yeah, that's good. And then I'll finish on this is what's kind of the most impactful book you've ever read? Now, for me, and I'll just kind of make it easier, set it off. For me, with no exaggeration and with no pause, the most impactful book to my wealth was One Up on Wall Street. Peter Lynch wrote it back in the 90s. I don't know if you read that book or not, but when I read that book, I was just like, oh my gosh, this is like, and it's served me so well over the years because it's even how I named my company. Core Wealth is have a core portfolio and then make investments in these satellites or explore in positions as you want. But that's kind of his kind of core strategy in that little short book. What would be a book you'd say impacted you?
Well, this is
And
not
you
this.
have it on your desk,
Well,
so
no,
oh
this
my
is sort of
gosh.
a no, it's sort of a good. I don't know if you can see all the books back there. It's kind of a
Yeah,
good
yeah, yeah.
confused answer, but like when Trump launched the tariffs, actually, this is advanced economics,
Uh-huh.
from Lake Forest College, right? Like, and actually, one of the professors, Rob Body, is one of the authors. So I'm like, well, how are tariffs affecting? How is that supposed to affect the world economy? Which is literally what this book is. So at the end of the day, I mean, like I said, as far as personal savings go, I'd say Millionaire Next Door. We
Yeah.
use different strategies, so I don't have one book that I'd recommend really, just because there's so many great ones. I mean,
Yeah.
we launched the original launch of Tactical was based on Joel Greenblatt's the little book that we beat Wall Street. It was my Harvard buddy that helped me launch that. That was Return on Invested Capital. That's one way to approach the market. Who would have thought Mag 7? So to me, it's like you read a ton of books, like our whole
Yeah. No,
office is
right.
book. So, but yeah, I mean, as far as personal savings, Millionaire Next Door, but you could read a book that would be applicable, like an index book, a DFA type of book, and it's great for 10 years. Then everything changes. Nifty50.com, the commodities,
Dogs of the Dow,
it's
right? I mean, there's just tons
you
of
got
those
to
kinds
read
of things.
everything.
Yeah.
Yeah, you got to read everything and have a lot of tools in the toolbox because what makes our business exciting is it's always changing. But
That's
that's also the
awesome.
challenge. Yep.
So let's finish. Give us kind of a quick overview of how to contact you and a little bit about, just kind of finish up with, kind of reaching out. If someone has something, they can reach out to you and how to reach out to you.
Yep. The typical www.lions with a y at lionswealth.com, s.reed at lionswealth, 407-951-8710.
Uh-huh.
If you go to the website, it features the majority of our products, which are the ones we manage are pretty complex in some ways. So yeah, just reach out either way and we'll be in touch.
What would be minimum to invest with you guys? So someone that's going to reach out to you, what would be kind of what they need to be kind of prepared to be able to
I
write a
mean,
check for?
I got hockey buddies with 50, 100 grand, but 100,000 is pretty much the minimum as far as
Yeah.
our
Okay,
programs go.
good.
Our mutual
Yeah,
funds 2,500, but the single stock position stuff, usually it's 500,000 to 1 million.
that
It,
makes
it,
sense. Yeah. So, all right. With that, you want to add anything? I really
No,
appreciate this
Tim.
conversation. It was wonderful. I really enjoyed the conversation. And like I said,
Yeah,
you and I kind of, our lives crossed paths, though we hadn't met, but
for
our
sure.
careers for sure kind of were zigzagging in and out of between each other. So,
No, and today was a great general day. I mean, I've been on panels to talk about tactical investing. We have our crypto program's up like over 300%. We have a futures program. So there's all sorts of niche stuff that we do that we could maybe save for another podcast.
yeah, no,
But
that's perfect. I
otherwise, yeah,
appreciate it.
that's great. Thank you.
Well, thanks again, Sandra. Thanks for coming on. And I appreciate it. Really appreciate the conversation.
All right, thank you.
Thank you.